All right, YouTube, everyone is talking about interest rates. I get it, but what does all of that mean for the purchasing power of the end consumer? What does that mean for us homeowners and for us aspiring homeowners? What does that mean in terms of discounts we're about to see in the housing market? Hi, my name is Vassil and I'm a chartered professional accountant by training. I'm a full-time realtor that's built and invested in real estate right here in Toronto, York region, and in secondary markets. Now let's get into the video. Now let's set the stage for this video and let's look at the last 7 months of historical data for interest rates and mortgages. Number one, 5-year fixed at the beginning of 2022 was 2.34%. This is from Rate Hub. Right now, the same product is 4.34%. So we've had an increase of 2% for 5-year fixed rates. In terms of variable, the 5-year variable was 0.85 at the beginning of 2022. So that's 0.85, and right now it's 3.5. This brings me to my next point. Historically, people usually opt for fixed rates. It's safer. It is a little bit more expensive because there's a premium to be paid for fixed, but that's what people prefer. However, because the spread is so big over the last 6 to 8 months, a lot of people have opted for variable. So that has made the split at about 50-50, whereas in the past, most people, so more than 50%, were taking on fixed. So right now it's 50-50. As I said, beginning of 2022, it was 0.85 for variable. For the exact same thing in fixed, it was 2.34. So that's a pretty large spread. Right now, the spread is tightening. So variable now is 3.5, yet fixed is 4.34. So the spread is smaller. So now probably more people are going to start looking at fixed. Plus, there's a lot of fear that, variable rate is going to continue going up. So therefore, more people are going to opt out for fixed. However, there is one more caveat. Because affordability with variable is higher, people are still opting and choosing variable at the risk of higher rates. There are two types of variable. There's variable where your payment does not go up, so that will be the TD, BMO, and CIBC. I believe their variable rates do not go up until you hit your trigger rate. If you're with Scotiabank, I believe they have two products where you can get variable where the variable payment stays the same, or one where it goes up and down with rates. And then all monoline lenders, I believe their variable rates go up with rates. Now, before deep diving into the actual numbers, I will use profile of a client of mine that's currently in the market. They have $200,000 down and they make just over $200,000 as a household, and they're looking to move into a townhouse. The townhouse segment has been extremely hot and volatile. They've been casually looking since COVID. They got more serious towards the beginning of 2021. They got priced out based on just prices going through the roof, where a townhouse like that was $850,000. Then it became $1.2 million. Now things are coming back and they're starting to entertain the idea of getting a townhouse again. However, there's obviously a bunch of moving variables. Let's get into the actual numbers and show you how they've been impacted through this entire process. So a quick note on pre-approvals and mortgages. Typically, everybody gets pre-approved on a monthly payment. It's based on how much debt they can service, based on their income, their existing debts, all that other good stuff. In this client's case, they were opting for a fixed rate simply because they're more conservative. The rate they were approved for at the time, I think it was in the beginning or at the end of 2021, was 2.34. And the monthly payment was $3,500. This gave them the ability to buy a $1 million townhouse. At the time, that $1 million townhouse was really $1.2 million. This is when the market was just insane. This is, let's call it the peak. We didn't do anything at the time. We decided to set that one out. So the pre-approval expired. Now they've been pre-approved again at the current rates, and they have, I think they have a 120-day lockup on that rate, meaning that their fixed rate is guaranteed for the next 120 days, or they can buy. They'll have to buy and close on a transaction within those 120 days for them to get the mortgage at 4.34%, which is the current going rate. What has that done for their affordability? Well, the payment, because they can service $3,500, or that's what they feel comfortable servicing. So they're working with this $3,500 payment per month. Purchase price, or what they're able to afford, is $845,000 for a townhouse. That is the equivalent of a 16% purchase power erosion. We're likely in for more interest rate hikes. The next one is in September. It is likely going to be a big one. I don't know if it's going to be another 1%, but regardless, we're not going to, let's assume the worst. Let's say it's another 1%, and let's assume that that translates to fixed rates going to 5.34. So then they're going to go down from $845,000 purchasing power down to $785,000. So that is a net decrease of 22% since the peak. Here's another scenario. While they could only afford $1 million townhouse at the time with the fixed mortgage, if they opted for variable, where the payment, again, we're working with a $3,500 payment, they're actually able, or they were able to purchase 1.15 back at the beginning of 2022. Right now, keeping the payment at $3,500 with current variable rates at 3.5, they're actually able to purchase at $900,000. So they're actually considering variable now, like a lot of people, simply from the affordability point of view, and because potentially rates may stop going up. Again, that is a bit of a risky move, and that comes down to everybody's risk tolerance. That is a personal decision. So I don't want you to think, hey, this is the right thing to do or this is not the right thing to do. Personally, I have never taken on a fixed mortgage, but that's me. I can sleep at night and I have buffer and I can manage it. But for some people, this is unmanageable. So just do whatever makes you sleep at night. If we account for an additional 1% rate hike with variable, that's going to put the variable purchasing power decrease from the peak until now at 22% decrease. And if I have one more interest rate hike of 1% or cumulative 1% rate hike throughout the remainder of the year, we're looking at almost negative 30% decrease in purchasing power. Averaged out between fixed and variable, assuming it's a 50-50 split between the mortgage originations, we're looking at, as of today, purchasing power has eroded by roughly 20%. And if we have one more cumulative rate hike or rate hikes that amount to 1% until the end of 2022, we're going to have a cumulative purchasing power decrease of 25%. Here is the price trend for all of GTA, all property types. We're consolidating the whole thing just to look at the aggregate. In Feb, the peak price on average throughout the GTA was 1.349 million. Right now in July, we're trending to close at about 1.093 million. That is a reduction in price of about 19%. And guess what I had just showed you with mortgage rates and what it did to purchasing power? It dropped roughly 20%. So this is a direct reflection of what interest rates are doing to purchasing power. There is one little caveat here. Because rates have rate holds and they're guaranteed for 90 to 120 days, a rate increase does not translate into a decrease in prices immediately. There's a lag of about 2 to 3 months. So there's a bit of a Mexican standoff happening right now in real life between sellers and buyers. Sellers, on one hand, they're thinking, well, prices they're dropping, but they've kind of stabilized, so all is good. Eventually, I'm going to get what I'm asking for. Meanwhile, you have buyers with pre-approvals that are about to expire. They're either going to act with the current pre-approval they have, or they're just going to sit back and wait for prices to drop further. So who's going to cave in first? I can tell you anecdotally right now, I put in about 4 offers over the past weekend, and while none of them were accepted, because obviously I'm looking out for my client's interest on the buy side, I want to make sure I'm front running the discount now. So I'm not going to pay you what your house is worth right now, because I know probably in 4 weeks it's going to be worth maybe 5 to 10% less. So we have to bake that into the purchase price now. Otherwise, I don't want my client to buy it. What's going to happen when we have the next rate hike in September? Likely exactly what I said. Prices are going to continue coming down. Hopefully they plateau at one point, or at least hopefully we'll get some sort of a stabilization so that people can be a little bit more rational. Every single interest rate hike does have a delayed impact. So for example, the people buying now in July are people that got pre-approved probably in May. If you're getting pre-approved now, the rate is already higher than it was in May and June. So therefore, the person buying now with a current pre-approval is going to expect a lower price, or at the very least, they should be. And this is why for sellers to try to hold off, directionally right now the market is trending down, so holding off is likely going to cost you. I hope you found this information useful. I think this example provides context and makes it a lot more clear what it means when interest rates go up, because we can all scream and yell at the top of our lungs, interest rates are going up, the world's coming to an end, but what does it mean? So we know as of right now, all the rate hikes to date have meant that purchasing power has eroded by close to 20%. That has reflected in the prices. If we have another 1% rate hike, whether it's one shot or cumulative over multiple rate hikes, we're in for probably another 6 to 8% of purchasing power erosion. And that is going to translate in prices shortly after, as lockup periods expire. People have to get reapproved at lower purchasing power, so on and so forth. The market right now is extremely difficult and tricky to navigate, especially if you haven't been through a market like this before with so much volatility. The one thing I'm going to leave you with is, if you're currently in the market looking to purchase, one thing from the buy side, one thing you should not be doing is do not try to beat up the sellers by telling them, hey, the market's going down, your house is crap, your house is not worth as much, the house down the street is better. Honestly, sellers have heard all of this. They've had all the low balls presented, all the arguments made. It doesn't move the needle. Unless you're looking to just beat them up or feel good about yourself, this stuff doesn't work. The 80-20 rule applies here. What you want to do as a serious buyer that's looking to actually get into something and potentially get a deal, 80% is going to be price no matter what. And then there's a 20% of gray area. And in that gray area, what you want to do is you want to build rapport with the listing agent to try to better understand what is it that the seller wants, what their concerns are. Try to get as much information as possible that then you can leverage for yourself when you're trying to make an offer so that the seller likes you. They will make concessions for people that they like, that are easy to work with, and that is how deals get done, and done favorably. But beating them up, trying to argue prices, honestly, it's going to fall on deaf ears. It doesn't work. This is not Kijiji where you can make an offer of $100 on something that's worth 500. It just doesn't work. I hope you found this useful. If you have any questions or you would like me to cover anything else, please let me know in the comments below, or email or text me. You guys know I love chatting real estate. And if you haven't yet, subscribe and like the video so that I know this content is helping you, and I'm going to keep putting out more of the same stuff. Thank you so much.